I love this question, and it could take forever. I could talk about it forever. The biggest change with the growth of passive investing is more who's buying, but also why. What is the decision process behind buying and selling? And over the last 15 years, my observation is that passive investing has done a phenomenal job of separating capital allocation from fundamentals. So the passive algorithm is, if I get cash, I buy, and if I get requested a redemption, I sell, with no regard whatsoever to fundamentals. That is great news in a sort of paradoxical way as a value investor, because the other math dynamic is that as the largest stocks become increasingly more concentrated in the indices, every incremental dollar further, just marginally, but enough, and over time a lot, further concentrates those large stocks. So if you want to buy a momentum-driven, concentrated tech portfolio trading at basically a very high multiple, buy the S&P. And it will just get more and more that way. At the same time, the rest of the stocks, and particularly this effect seems to be most absent in mid-cap and small-cap names. So those are ignored stocks. By the way, the other piece of why passive investing is growing, it's a self-reinforcing loop, but there have also been very important 401k regulatory changes that require, with the opt-out methodology for young people signing up for 401ks, employers now basically, unless you pick, and it's really hard to pick something that isn't a passive, you are put either into a passive index or a target date fund. So, which is effectively stock and bond based on your age, but the stock part of it is passive. So I would say this feature is least influential in smaller cap and mid cap names, and paradoxically has created very attractive opportunities. The thing you have to be careful about is like a tree that falls in the forest. If nobody hears it fall, did it make a noise? You don't want to be that person, the portfolio manager that buys a cheap stock that nobody cares about. All the flows are going elsewhere, and you just sit around owning this cheap stock for which you will never get paid, right? So that's the other side of this paradox. And what we have concluded, and why I have focused so much of my talk today on cash flow, is that ultimately a stock price will reflect the economic value that the company creates, right? So the future cash flows of a company are what will price a stock eventually in the long term. So while book value is a lot weaker as a mechanism, earnings has always been able to be manipulated. Cash flow is hard and real. And if you are buying companies that are generating excess cash over a long period of time, they cannot be ignored forever. They are financial inevitabilities, even in a world of passive indexation. So I would say we have adopted a very focused approach on the cash flows to not be negatively affected by this sort of passive bid that's out there and quite, in my opinion, disconnected from the fundamentals.